All right. Okay. We here. We here. We're doing it. We're going right now. We're going right now. This is live. Okay? Can't be edited out. Can it be? We here. Let's. Welcome back. Welcome back. This is Hour25. My name is Nick. If you're new here, top of the muffin to you. This is episode 8. Current events and how we got here and what is here that I speak of. Why is crypto hot? The history of money. So the first part of the video will be current events, what's going on, what's kind of taking place. And the next part after that will be sort of a history of money presented to you by an idiot. Or a genius! Or an idiot. Let you decide. But I don't know. Somebody needs to drop a clock on them. That's all I know. Can I get somebody to drop a clock on them? Huh? All right. No time to waste. The time you need but don't have. Hour 25. Let's get into it. The 10-year Treasury, it's at 1.594%. This is a yearly chart. This is what the 5-year looks like. The markets, as I understand it, really follow what this 10-year Treasury does. They also follow what the price of crude oil is, which is currently about $65 a barrel. Crypto, always something to talk about here. Ethereum's been popping off lately. It busted through 3,000 easily. I mean, it almost like it wanted to hit 3,000 and continue because it sits right now just below 3,400. Doge, got to talk about damn Dogecoin. At 55 cents, I saw it. Maybe it was at 56, 57 cents. It was a little higher than that. It's come down a bit, but Doge is also ripping. ADA's nice. It's hanging out. Nice and steady, nice and stable at 132. Not a terrible amount of volatility, but it still has a good amount of volume. Just not as much as like $36 billion in volume for Dogecoin in 24 hours is just absurd. Especially when you look at the similar volume for Bitcoin and its market cap compared to Doge. So cryptos are surging still. I don't personally see the market coming back a significant amount. I know that it recently had 2 pullbacks. I think those personally were healthy and they were nice consolidation. I could be dead wrong. This is not advice at all. That's just where I stand and how I see things. I do think they're going to continue to rise. For how long, I'm not sure. I kind of just play it day to day like the Patriots did and see where things lie, see where it takes us and what's going on. Another update, just to speak on Ethereum and perhaps why it's breaking over 3,000. Just one take on it from this gentleman here. In part, the big rally is a catch-up to the late 2020 gains in Bitcoin, says James Quinn, managing director at Q9 Capital, a Hong Kong cryptocurrency private wealth manager. It also reflects improvements to the Ethereum blockchain, he said, which I do also believed to be accurate because recently they may have patched something. I could look into that further, but they may have patched something recently because I know gas fees were down some, which was really huge because let's say you want to put $1,000 into Ethereum, you know, if in 2 transactions you're going to lose 10% of that in principal, you know, it makes it really hard to move that money around if you want to do something with it. Other breaking news, COVID is killing 120 people an hour in India, and it could stay really grim for months. This was interesting, and I thought you might want to see it as well. A trippy visualization chart of the internet's growth since 1997. I think he initially started it like this. This was in the 2000s, or of the internet in the 2000s, and then this is what it looks like today. Pretty sure he did all this. You can come to the article, link will be in the box, and it was just kind of over a wager that he made at lunch with his coworkers. that he said he could map the internet with some software that he had, and they didn't believe him, and he bet them $50, and this is what he came up with. So that's pretty cool. Another interesting topic: KC tanker cruise uses PIKLRICK call sign, and the Air Force is not amused. There's a refueling tanker, and it was on a mission in the Middle East, and the crew members of that KC-110 used this call sign, PIKLRICK, as a nod to the animated comedy Rick and Morty. So that's going to kind of do it for the first half of this video. I just wanted to touch on some things that are happening. Ethereum going off, Doge going off, India's in trouble with the vaccines. I do hold shares of Ocugen, who I know is working with an Indian manufacturer so that they could help them distribute their vaccines in India. And Ocugen is on their phase 3 trials, or late in them, and there's been a lot of positive news lately. So that's one thing going on. Another thing going on, Biden did say, he just released that he wants 70% of adults vaccinated by July 4th. That's a big initiative that he's now pushing. But part 2 of the video is about to begin. We're going to get into just kind of how we got to what we use today for money. I'm just going to try and do it quickly, thoroughly, and in order. So let's get underway. From my understandings, the way we got to using Federal Reserve notes as we use today, what we call dollars, is through gold, precious metals, into fractional reserve banking, and then into what we have today, which is just like the farthest evolution of Federal Reserve banking and now cryptocurrencies. So it started with Goldsmiths. Some of them, I'm sure there were, dozens of them, several in different areas that were trustworthy, and people trusted them to leave their gold there because, they had the means and to have a facility that could secure it. But some of the people were Mayor Amschel Bauer, the son of Moses Bauer. You're familiar with their name as Rothschild. They later assumed that name because it was a red shield that hung above their door. And in German, red shield is Rothschild. So they later assumed Rothschild, but they went by Bauer. But they were money changers and goldsmiths. And essentially the way the evolution worked was gold coins were too heavy to carry around. It wasn't feasible. If you were, fairly wealthy, you're not going to carry around 20, 30, 100 pounds of gold on you. One, it's not feasible physically and logistically. And then two, it's, prone to being stolen, and it's not safe. So you would leave it, you deposit it with the goldsmith, and that goldsmith, let's say you gave them 100 ounces of gold, they'd give you a certificate back saying this certificate is as good as 100 ounces of gold. And then you could take that certificate, or let's say he gave 10 of them representing 100 ounces of gold. You could then use those certificates to then conduct commerce with. A lot easier to carry, a lot more safe. And then the person who received that note, they took that note to be literally as good as gold, because that note said payable to the bearer on demand, meaning whoever garnished this note, or whoever had this note and brought it to the bank, the contract was that I could then exchange this very note for whatever it was denominated in. Let's say it was $20. I could get $20 worth of gold. So it really started with goldsmiths, mainly people just housing their money there. Eventually, they realized a very small percentage of the people who deposited gold came back for it. Whether it was 10, 15, 20%, it was a very small amount. What they realized they would be able to do is put that money to work and leverage the deposits they have by loaning it out, or essentially increasing more paper certificates than they really had gold for. So it was that evolution that really started what we now know as fractional reserve banking. So let's say there was a village or a town, and 10 people all left 100 ounces of gold in there, so we got 1,000 ounces of gold. Not everybody's going to come back for that gold all at once. So if they issued, let's say, 100 certificates representing the value of that 1,000 ounces and distributed to those people who deposited the gold, basically they could lend out 10% more, 20% more, because no one's really going to notice that there's 10 more certificates in circulation than there's supposed to be, until you start lending out too many and people realize, hey, there's too many certificates. I don't trust my money being in this institution, this Goldsmiths vault any longer. I'm going to go get it. What happens is if too many people do that, then there's a run on that bank or that holder of money because they can't actually cover all the certificates they've issued. So that's how you would lead to a bank run. But essentially, no one comes back for the gold. You lend out a few more certificates, you make extra earnings on that money or gold just sitting there, and everything goes smoothly. That transitions, goes on for a while, and it just kind of, let's jump to the creation of the Federal Reserve, which in a sense centralized all that power and became the nation's private centralized bank. So what they would do is they really mainly have two tools. One, and each tool can go up or down or has two things it can do. But one tool is they create and control the amount of money in circulation. So that can either be increased or decreased. They can open or close that window. The other tool is they control the interest rate, and that also can either go up or down. And it does exactly what it says, sort of. It doesn't really hold any actual reserves, and it isn't federal. It's federal like Federal Express is, but that's what it does. Essentially, it creates Federal Reserve notes, and it lends them to our Treasury, and our Treasury prints up bonds and gives them to the Federal Reserve in exchange for the notes. Those notes are then lent to banks, big, large commercial investment banks, and then from there that money is distributed. The Federal Reserve, if you want to know more about the Federal Reserve, I would recommend checking out this book, The Creature from Jekyll Island, which refers to an island just off the coast of Georgia, but it was written by a gentleman, G. Edward Griffin, and it's really considered the historical reference to understanding how the Federal Reserve came to be. So if you haven't read it and you're not familiar with it, I would check it out. It's a really popular book. Now, everybody's always talking, oh, how much money we've printed in the last year. And look at the chart. It's, ever increasing. And it, last year was like 30% of the money supply or whatever everyone's saying. And Trump's stimulus bills and Biden's stimulus bills. No one ever really talks about that. Most money is created by the bank. It's not created from the Federal Reserve, who brings it into creation. So what happens is, let's say we need $1.9 trillion or $2 trillion. Once that exchange is made with the Treasury and the Fed, and we have that money, or the Fed issues it directly to banks, those banks, because of Federal Reserve banking, actually create most of the money in circulation, because what they're allowed to do is get that money. If let's say I got $100, I can lend out. Now it's changed over the years, your reserve limits and what you had to have. It's essentially decreased the limit. So nowadays it may be zero or very close to zero actual reserves you have to have on the books in order to keep lending out money. But as a bank, you would get that $100, and I could lend out 90 of it traditionally to someone else. I would put it in your account, but I can lend out 10 times that amount from that original $100 deposit. So that's where most money comes from. So let's say the bank gets $100 million. They can lend out $1 billion off of that. And that's traditionally. I mean, if it's less than 10%, they could issue more. Now, where it gets crazy is if the person they lent the money to then redeposit it back into their bank, they can now lend more money based off that deposit as well. So that's where most money is created, and really no one ever talks about it when people refer to, these infrastructure deals and all these packages and the annual budget and how we, are broke and we need more money and should we sign it or should we not sign it? I mean, the 2 trillion is a lot, but it doesn't compare to what's actually created once it gets into the banking system and it's lent out. So just think that's something we should always keep an eye on. But the timeline kind of goes, and I'm not going to go back, several hundred years or thousands of years. It's just going to be a couple hundred years to the 1700s and on. Went from Goldsmiths issuing more certificates than they had on demand, to that sort of becoming institutionalized in the Federal Reserve. Then the Federal Reserve, initially we sort of had a gold backing, and then in 1933, we had the bankruptcy and all that. All that history I think is pretty common with people. It kept going, through World War II, and then it brought us to when Nixon took us off the gold standard in 1971. You can go to YouTube and you could check out a quick video of Nixon where he announces us coming off the gold standard, which he does say was supposed to be temporary, but never was. That's when Federal Reserve banking really flourished, and we went on to this whole fiat money system where we're just going to continue to increase the money supply and manage it and just have enormous economic booms and create more money. It's not like when we go to get this money, it's not like it's been saved and it's sitting there. Oh, here's $2 trillion that I've been saving and here it is and you now have it. That's now how it happens. I mean, essentially, it literally is created out of nowhere. But it is created out of nowhere in debt because it doesn't get to the U.S. government, the treasury of the government, without it already have being loaned at interest. So inherently, we're using debt notes or instruments as a monetary exchange or as a something that we exchange money in. So it's very weird. It's very crazy. It's weird to wrap your mind around. I didn't come up with any of this. This is just all things I've discovered as time has gone on, and it's interesting, and it gives you a good perspective of where we are. Why are we here? I mean, essentially, crypto, from my perspective, is born out of all this irresponsibility with the money. People were looking for alternatives, different things that they could do to secure their own wealth, create fortunes for themselves. And one way of them doing that was to create some sort of decentralized digital system, because that's, in the 70s, 80s, 90s, that's where the world was moving towards. So it kind of sparked the opportunity out of the frustration of what had been going on with the dollar for them to create cryptocurrencies, in my opinion. I think, a lot of the passion behind that is fueled from things like that. Not all of it, but we went over where most money is created. It is created in the banks, just out of the mechanism of how they can loan money. I was trying to show this as well. I had heard a different stat. I thought I had seen it years ago on the Federal Reserve's website as well, but an update. So they say here basically it costs 6.2 cents per note for a $1 and $2 bill, and then 14 cents per note for a $100 bill. So it kind of shows you that it's not really based on anything logically. I mean, you would think that it should cost 100 times more to print a $100 bill than a one, but it doesn't. It's really only like 2.5, not even, times more. The old set I had always referenced was it cost about $21.60 to create 1,000 notes of any kind. I didn't potentially printing a different denomination and picture and all that on the front costs more than otherwise, which I could see maybe the ink in it is different and it has a slightly higher cost to it. But essentially, the point is that it's not really backed by anything. Whether it has a 1 printed on it, a 5, a 20, a 50, or a 100, it really costs the same amount to make. there isn't anything backing it saying, yes, this actual piece intrinsically is worth more than this piece that has a 1 on it. Technically, they're the same thing. We just look at them differently because of how it operates in our system. And it's fine to operate that way. The problem is when it becomes fiat and it just continues, you don't have to be, you don't have to have an economics degree from Princeton to understand where this goes. It's pretty simple math, although maybe certain people like to spice it up and use a lot of jargon to describe it. It's a very simple thing, supply and demand. And, over the next couple years, it looks like there's just going to be more and more stimulus needed all the time in greater amounts. And it kind of makes me think of what Ray Dalio had recently said about how cash is a killer. And he's, I don't know how much he's worth, 8, 14, 20 billion dollars. He won't keep, this is somewhat exaggeration or hyperbole, but he doesn't or won't keep any of his money in cash, really, because essentially by keeping it in cash, it's just being debased and devalued, and it's losing its purchasing power daily and monthly. Because the Federal Reserve, we see these big bailouts, or we'll see these stimulus things that they issue, but no one ever really talks about the quantitative easing. I mean, you hear about it and it's talked about, but no one really ever understands what it is that's going on with that. But they are currently, and it's increased in the last couple of years, but you maybe start around 40, 50 and went to 80, but I'm pretty sure it's currently around $120 billion per month that the Fed is putting into the system or creating to purchase, bad debts and different things like that. Because now the Federal Reserve has its own trading desk, which is kind of crazy to think about, but they've created different channels and they can go directly to the market and just print the money to buy whatever commodities, equities, debts, mortgages, securities that they need to. And I'm not a financial person, but I do like to follow everything. I like origins. I want to know why all this is happening. Where did it come from? Without understanding that, I don't really think you can truly understand where it is that you are. I'm not even sure how long this video has been going. I've kind of just been spitballing off the top of my head as I think of more things to say. I did gonna have a layout of how this was all supposed to go, and it sort of followed that, but not really. But we did touch on everything I wanted to touch on. If you didn't like it, I want to know. If you want more content that's, I don't want to say edgy, but just a little more raw and real, let us know. We are going to be having someone who's about to be a CPA and has been working in a tax firm for a while. We're going to have him on a Zoom call just to pick his brain and see what kind of information he can give us that would help us all out. We do have some big things planned on what we want to do with the channel, so keep on viewing, keep on giving it a thumbs up, share it with people if you think they'd be interested in knowing about it. We just want to keep it going and keep it growing. So amen. God bless. If you made it this far, thank you, and we'll see you on the next one. I'm going to put the link in the box. Tell you what, the shirts, hey now, the shirts are in. I don't think I've worn any other shirts since they came in. I gotta be honest with you. A little bit weird like that. I'll add another. If you see someone wearing this shirt, it's like, I guess, owning a Jeep Wrangler and you see someone in another one when it's a nice summer day and you wave to them and hey, you honk and everybody's happy. But when you see someone in this shirt, it's even better than that, because if you're in the Jeep Wrangler, I don't know if you get it. I don't know what you're into. Like, I just know that you like a Jeep, and I got one too, and we wave. You see someone in this shirt, you know they get it. How about it? 2 colors. Got it in black as well. Giveaways live. Another 2 weeks, maybe just shy of 3 weeks left. See the link in the box? I'm gonna put the link in the box, and we'll see you.